So welcome to all of you. We're very happy that you can be with us for the next 90 or 120 minutes. We'll start with a few welcoming remarks from Johannes Grün. Can we have you on the screen? Yeah.
Thank you, Jürgen. I'll keep this brief. Welcome here today for the ones that are here in Berlin. Welcome to Bread for the World. And of course, the ones that have been here in the past have recognized that the conditions under which we can meet here physically have changed. And I would like to thank everyone that you are willing to accept this changed conditions under which we have the chance to meet. Hopefully it has not changed that much in terms of our hospitality, but I think it's a great opportunity that we can meet here, and thanks a lot for the technical support that is helping us a lot today. I will keep this very brief. There's a saying that crisis times is government times, and therefore I'm very happy that in these troubled times the chief economist of the German Ministry of Finance, Jakob von Weizsäcker, has the chance to join us today and spend his time discussing with us. Thank you very much. We highly appreciate this. And I'm very glad to see how many of our partners, allies and friends worldwide will join this discussion today, because I have to admit, many of them have gone through very difficult times, and yes, we were worried, we sometimes still are, and so it's even better to see that many of you will join this discussion with us today. It's a bit more difficult than in the times before Corona to make the voice of civil society heard in some of the political discourse today, and therefore taking this more efforts than are necessary at times. I would like to thank everybody who is and has been involved in organizing this event. Thanks everyone for joining us here in Berlin, worldwide, on the screen. I look forward to fruitful discussions, the necessary controversy, of course, and as always, wise conclusions. Thank you.
Okay, thank you, Johannes. Normally, now we would have a sort of applause, giving you a hand or something, but online that's a bit more difficult. Thanks a lot. Thanks for your hospitality here. Before we move into substance, just a few remarks on the agenda and on the technicalities. We are going to hear in a minute a brief introduction by Christina Rehbein, who will put us onto where we stand with regard to the debate on debt relief as a response to Corona. I will then start with an introductory question to each of our four panelists, and then we will open the floor for questions from both the room as well as from our online F&A question, for all the F&A function on Zoom. For all those who are here in Berlin who want to speak up, do it please the old-fashioned way by just raising your hand. I will see it. And the same goes for our panelists. If you want to take the floor, please just raise your hand. That's like in the good old times. For all those who are with us online, please type your question or commentary in the Q&A function, not in the chat box, but in the Q&A function of Zoom. And my colleague Tobias will monitor this function and will then will then transmit the questions to me. I have a wonderful screen here and can read all this. For instance, I can now read that some people have asked whether they can ask questions in German. That's definitely the case. Please do it. I'll do my best to translate them into English, or Tobias will do it. You should also know that this event is being recorded, so please be aware that we will try to document it. We'll start with Christina. A lot has happened debt-wise since the beginning of the year. Please introduce us to the milestone and set the scene for our discussion.
Thank you very much. So the central issue of our discussion today is looking back at what has been done since the beginning of the COVID-19 pandemic, and especially looking at what further needs to be done right now and in the future to respond to the repercussions of the unprecedented economic shock that was caused by the pandemic, as well as to respond to the more systemic problems and the systemic long-existing inequalities that have been laid bare. Looking back, in April, shortly after COVID-19 was declared as a pandemic, we have had a scenario not seen since 20 years, not seen since the heavily indebted Poor Country Initiative. That is the decision for group-wise debt relief. The G20 Debt Service Suspension Initiative for 73 countries, the DSSI, and IMF Debt Service Relief for 25 countries. The urgency to react, to provide financial breathing space to those not having own means to tackle the pandemic, that made it possible to have a quick consensus for a debt relief initiative for a whole group of countries, which is in stark contrast to the usual individualized case-by-case debt treatment. However, the important difference between the G20 DSSI and the IMF Debt Service Relief and the HIPC initiative 20 years ago, number one, HIPC was about real debt cancellation. It was about providing a number of countries a fresh economic start. This time, we only see very limited debt cancellation. We see the provision of very valuable liquidity relief through postponing payments that gives time to breathe for the chosen countries. But liquidity relief, of course, won't deal with any more structural solvency crisis. And it also falls short of the effort and the scale that is needed. I think at the beginning of the pandemic, the minimum that was estimated that is needed in form of debt cancellation for the poorest countries is $1 trillion. And real cancellation from the IMF is just $215 million, and the Debt Service Suspension Initiative only gave around $5 billion breathing space. Then different from HIPC, number two, is the lack of comprehensiveness and truly collective creditor action. So we have multilateral development banks that insist not to participate in debt service suspension, instead offering loads of new money, which however may result in a higher long-term debt burden for countries. Then the elephant in the room is the lack of private sector participation. Calls for voluntary participation since April went nowhere, which however means that the DSSI de facto has turned into a private sector bailout. That also means less flexibility for governments in the global south who are faced with the impossible choice of saving the lives of their citizens or making debt payments to their creditors. Different from HIPC number three, on a more positive note, HIPC came at the end of a decade-long protraction of debt crises, which led to the well-known lost development decade in debtor countries and which led to costly write-downs for creditors. This time, the world entered the COVID crisis being at the beginning, not at the end of a global debt crisis. This means we do have a chance to prevent that the 80s are happening again. The DSSI provided briefing space, and this must be used for decisive action to address the upcoming solvency crisis. There are signs that should encourage us to make sure that this good crisis will not be wasted again. One, already before the pandemic, there has been the recognition that the current global financial architecture is not fit for purpose to resolve the upcoming debt crisis, which means that we need other structural multilateral solutions. Two, there is an extraordinary UN process initiated by Canada and Jamaica going on, where for the first time ever, finance ministers have met in the United Nations. And in this process, we have seen the development of a menu of very good policy proposals. Among them, broadening the scope of the DSSI and include not only the poorest and therefore cheapest countries, but link qualification criteria for the debt suspension to need, to debt vulnerability. There are proposals to enforce private sector participation in debt suspension. And there's the clear acknowledgement and clear concrete proposals when it comes to the need for short-term real debt cancellation, as well as for more medium and long-term debt restructuring processes. Central in the menu of options is the acknowledgement that action on debt restructurings, including debt cancellation, right now might reduce the need for potentially devastating, costly sovereign debt restructurings in the future. And this is what should guide discussions on what to do next. Finally, in official discussions, we have perceived the willingness to discuss a case-by-case debt treatment of DSSI countries in need. Now, any assessment of debt treatments will be based on IMF debt sustainability analysis. And we have noticed that the IMF expects growth recovery in individual countries to materialize very quickly, despite of senior IMF leadership warning that there is a risk of widespread debt defaults. We in civil society, we fear that like in pre-HIPC times, individual over-optimistic growth expectations will serve to suggest that further debt relief is actually not really needed, which will in the end lead to what we should all want to prevent, which is protracted debt crises. And that is the kind of biggest current risk besides the recession's fallout, that is the risk of widespread disorderly debt defaults that will stall recovery and that will undo hard-won social and developmental gains. Thank you.
Thank you, Christina. I think that is already quite some food for further discussions. I would like to kick that off by a question to each of our panelists, and would like to start with the G20 in the person of Jakob von Weizsäcker, the only representative of the G20 in this room at the moment. The G20 has been very much the driver of what has already been decided so far, both in the IMF as well as with the DSSI. What will come after the DSSI? Will there be any extension? Will there be a transformation into something more substantial? And if it is being extended, in what form? More countries, more amounts, more time? What can we expect from upcoming the upcoming finance ministers meeting during the IMF World Bank annuals?
It's a very good question. And of course, I'm not a G20. I work for one G20 member state. And so I cannot tell you what the G20 will decide in the future. But I think I can give you some idea of what kind of thinking is going on by briefly confirming the reasons we've already heard for why the DSSI, when it was decided very rapidly, was at the time the right thing to do, and then explain why perhaps just extending it like that for another year may not be the way to go. So let me start by saying why at the time this was the right thing to do. The G20 did play a key role. I think we mustn't underestimate the role also of IMF and World Bank. And we mustn't underestimate the role of the Paris Club, which has a slightly different membership, but increasingly G20 members, they're not all there yet, but increasingly they're members of it. And the reason why I think at the time DSSI was the right measure, that we had a massive shock, a massive crisis, but coupled with massive uncertainty. And this massive uncertainty meant that the distinction, which in theory is always very helpful between liquidity problems and solvency problems, in that kind of massive uncertainty, you know that there will be some solvency problems, you definitely know there will be some liquidity problems, but it's very, very difficult during the first couple of months of such an unprecedented event to have any good bearing of what it is. And so in light of that uncertainty, deciding very quickly, and that was the second requirement, dealing with uncertainty and acting quickly. I think coming together and saying, let's, at least for the poorest of countries, as official creditors, quickly agree on the moratorium. It's not perfect, and you're absolutely right. There's a big problem with the private sector, and I can assure you, had it been possible to fix it easily, with view to ratings and default events and such things, we would have definitely done that. But it's a big problem because as time goes by, it increasingly morphs for countries on the verge of insolvency into something that is rather beneficial for private sector creditors and a problem for taxpayers. But at the time, I think it was exactly the right thing to do. Now, as we move into 2021, there are some differences between the immediate crisis situation. The first difference is that, yes, indeed, the private sector participation problem becomes bigger as time goes by, and we cannot ignore that. Secondly, while uncertainty is still high, we have a slightly better idea of the future. And we are starting to have slightly better ideas of which countries really have a problem of solvency and which country in all probability just have a problem of liquidity, and the sort of area of gray will start to diminish, and that will allow for somewhat more tailored solution. And that is why I would be hoping for a slightly more differentiated approach, not an approach that says on the 1st of January 2021, we will have all the ingredients necessary to do a kind of triage between different cases, but a staged process that allows us to use the additional certainty as information is coming in order to have a differentiated treatment and in order to make certain that for the countries where this is relevant, we deal with the private sector issue, which is possible to deal with in the case of restructuring, but unfortunately has proven not to be tractable in the case of DSSI. So I hope, even though I cannot directly answer your question, this gives you a little bit of a bearing of how one could think about the problem, and the problem is being thought about.
Mm-hmm. Thank you. There was quite a lot of mentioning of the problems with getting the private sector on board, which of course is the long ball played in the direction of London to Kevin Daly. We recall that in the past, private creditors actually had been at the forefront of organizing sensitive debt relief at times when official creditors still thought that taxpayers' money would have to be repaid dollar by dollar, like in things like the Brady Plan, for instance. And that contrasts very sharply with the walking away from the problem that we have seen from the IIF, really. And it now looks like privates think that they can put all the onus of the crisis on the official sector. Kevin Daly, is that the case? Is that what private investors are thinking, that they can run out of this crisis without taking any hit at all?
No, I mean, I have to politely push back on that narrative a little bit here. And I think the reason why is, first of all, if we go back to the announcement back in April, there was a lot of confusion in the market, in the media, commentators, but most importantly, there was a lot of confusion at the issuer level. And this was brought to my attention through various discussions I had with Vera Songwei, the Secretary General of UNECA, and with the African ministers themselves. And again, this confusion stemmed from the fact they didn't know the ramifications of not just participating in DSSI, but also the this very touchy and sensitive issue of private sector involvement. And in these discussions I had with them, I said, look, it's not my decision whether you're going to seek PSI, but this is these are the ramifications. These are the the impact. The reality is that it's going to be very difficult at times to go through this process. But if it is something which is essential, then there's a process which, and we use the Ecuador model. Obviously, Ecuador is not a DSSI country, but at the time, Ecuador was going through a debt restructuring around this period. So we gave them the example of how they approach creditors, going through a hiring advisors, going through a consent solicitation. So it's a very tricky process. Now, along the way, and again, we don't write these rules. We have client mandates that prohibit us from investing in countries with ratings below the B- level. And if you get obviously a country decides it wants to seek consent solicitation those ratings are very likely to have been downgraded below the B- level before that consent solicitation is announced. And then when it happens, obviously you get the forced selling, and therefore the losses which private sector are going to bear are going to be more significant, because we're mark to market on a daily basis, our funds, and then our clients will question whether we should be investing in these countries to begin with. So there's a real series of knock-on impacts here. And again, we don't write these rules. These are just in your typical emerging market mandates. So, going back to the question of whether, we are going to be involved, I mean, we've always been, investors have always been open, and I think this is important to highlight, have always been open to discussing with a country if its debt levels are unsustainable, or if it's in need of debt restructuring. Again, using the example of Ecuador, very successful, the way they were able to complete it, restructure their debt. And now we're in the process of engaging the Zambians on this as well. And I think this is, we, again, as creditors in Zambia, and have been involved there for many years, going back to 2012 when they issued their debut Eurobond. We are happy to engage with them. We're in the process of doing that right now. We have a call next week with the government and with the committee. We'll follow up on that. But I think it's essential for us as creditors to have transparency with these countries. And that's another, very important and touchy subject, especially with a country like Zambia, which is in the process of restructuring its debt. It's well known that they have a significant amount of liabilities with Chinese lenders, and there's not a whole lot of transparency around those loans. And if we go back to the last time Zambia issued a Eurobond, which was in 2017, at that point, the IMF did not view the debt, the country's debt is in high debt distress category. But in the ensuing years, they were drawing down on these Chinese loans, and also these loans amortize at a very aggressive rate. And hence, a year or two later, the debt was viewed as unsustainable. And I think, we're certainly going to be involved in, I can't tell you exactly what a restructuring is going to look like there, but I can tell you that we will be, there will be extended maturities on Eurobonds. There will be much lower interest payments going forward. And, possibly there could be a principal haircut. So we are, happy to engage. The private sector is happy, will engage with countries on debt restructurings, and we'll continue to do that. I think, if I just, I'll conclude my comments here in a second. If we just go back to the DSSI, I think the confusion that was emanated around this was the one-size-fits-all approach. And, I think there are certainly countries out there, DSSI eligible Eurobond issuers, of which there's 17, which clearly did not need any sort of coupon relief. But if they'd put their hand up in the air and said, well, yes, it's being pushed upon us by the G20, it is going to be mandatory. Now, obviously it wasn't, but if that was the case, you wouldn't have a country like Honduras, which very successfully was able to raise 600 million back in June. And the deal was, there was 4 billion demand for that bond. And, again, there's countries which I think probably value this ability to have market access, and it'll be necessary in the coming years. So I think there's a lot, again, if we go back to when this was launched, there was a lot of confusion at the issuer level. And, I did my best to try to educate the African ministers through the efforts of UNECA. But I think that education process continues to this day. And I would still say there probably still is some level of confusion amongst some officials in these countries, because frankly, they just, this was something which, probably caught them by surprise to some extent. But I think more importantly, they didn't really have anyone out there to educate them on the pros and cons of going down this route. So let me just stop there and with that, and hopefully I've addressed that question, but I'm happy to address it with some other examples as well. Thank you.
Thanks. If the private sector is so benevolent, why was there a zero response to the call for participation in the DSSI?
Well, I think there's several reasons. One, because it wasn't it wasn't mandatory, right? It was voluntary. Secondly, I think and this goes, it's not just the public, the Eurobonds. There's a lot of loans out there which are involved, which potentially could be triggered in terms of a default on these loans if there was some rescheduling of interest payments on Eurobonds. So there's a lot of and loans which are tied to trade finance, export credit agencies, things of this nature. Those are even more complicated too. So I think there's, again, if a country had come to us and said, we would like to reschedule these coupon payments, then we would have engaged with them. We didn't say no. And I think this is important because I've had these discussions with the ministers, and I said, look, I'm not going to tell you what to do. If your country is in need of some form of debt relief, then please approach us and please let's have a discussion. And you should reach out. You should hire a financial advisor because that's how they have to go through these things. You need to hire legal people. There's a process involved that these countries have to undertake. They can't just come to Aberdeen or some other fund manager and say, we'd like to reschedule these interest payments. They have to do it formally through a process, and therefore, it's a publicly launched initiative where they announce it to the market, and there's steps that need to be undertaken to do this. So we're certainly, as I said, it's not our decision; it's their decision to come to us. And again, I'll happy to discuss in further detail, but I think it's also somewhat unfair to say the private sector hasn't been doing anything. I think we actually have behind the scenes been trying to come up with some financing solutions for these countries. And these are ongoing discussions, and I'm happy to elaborate on those further during this discussion today.
Okay, thank you. I have heard two things or two types of arguments. One was that actually participation in the DSSI or debt relief in general might actually work against the beneficiaries. And the other one, that there was a big problem with the DSSI, namely that it was not mandatory. Jeremy Zettelmeier, perhaps you can respond to both of these issues. What's your experience? Was it a bad idea of the G20 to organize something like the DSSI and calling on the private sector to participate? And secondly, if Kevin Daly speaks about making it mandatory, that would certainly be perhaps an invitation to the IMF to change the rules. Would that be the right consequence?
Thank you. So the DSSI was a good idea and is a good idea, and it is a good idea to extend it because there continues to be a need for what the DSSI can provide and was designed to provide, namely financing, so liquidity relief. Given this limited objective, and I completely agree with Christina Rehbein that it is a very limited objective. It doesn't address solvency problems. It just provides breathing space and allows countries to prioritize critical expenditures related to health or economic support over debt payments. Given this limited objective, I think the DSSI was designed as well as it could have been, and that includes the fact that private sector participation was not made mandatory, because if it had been made mandatory, many countries that are currently benefiting from the DSSI, and that's about 43, I think, by the latest count, would simply not have applied. So we have a whole bunch of countries in the DSSI that have fought very hard to obtain market access over the last decade or so. And these countries just would not have been willing to jeopardize their relationship with market creditors to get limited liquidity support, which is what the DSSI is. It is not a big debt relief initiative. Now, going beyond the DSSI, I think we all agree that deeper debt relief will be needed for many countries. The question is how to do this. And so I think there are basically three options on the table. So the first option, I think, is the one that I kind of infer from Christina's opening remarks might be the preferred option of Alasia, which is a broad-based debt relief initiative, kind of like the DSSI, except maybe to an even larger group of countries, and offering not just liquidity support, but solvency support. So true NPV debt reductions or even face value cancellations. So this type of broad-based initiative has two problems. The first is that some countries may receive debt relief that needed much less than others. So, you know, if you define this as a group of countries, for example, along per capita income lines, then you're going to have lots of liquidity cases as opposed to solvency cases that would benefit, to use Jakob's distinction earlier. So the money does not necessarily go where it is the most important. And then the second problem is the treatment of other creditors. So, for example, should multilaterals participate? Then you will need some sort of multilateral debt relief initiative, which ultimately will either, you know, if you want to preserve multilaterals and their capacity to function, will require much more money from bilaterals. So they should be probably left out. What about the private sector? Well, if you impose comparability of treatment, which is make private sector participation mandatory, the problem that, you know, prevented private sector participation in the context of the DSSI may come back. So if the debt relief offered by the bilaterals is too small, countries may again choose not to participate, rather than, in a sense, forcing private sector participation at the cost of reputational losses and rating downgrades. Now, this all said, there is a solution, a possible solution, which would sort of solve both problems, in part at least. So in principle, there could be a coordinated debt relief offer with comparability of treatment of private sector, so mandatory involvement, which is just large enough to incentivize large-scale participation by the countries that need it. So if you offer enough money, true debt relief, so that countries actually bother to do a consent solicitation to private creditors on comparable terms, even though they're going to get punished for it by the markets, that could work, right? So that is theoretically an option. But again, you know, you will not be able to completely get rid of the first problem, namely that you are treating all countries the same in spite of greatly differing needs. The second approach you can do is sort of quite a cool, intellectually cool idea. It's an old idea, but it was resuscitated recently in a very thoughtful paper by Hamid Rashid, who's the chief of global economic monitoring at UNDESA, and Joe Stiglitz, which is to use market-based buybacks financed by the IMF and possibly other official sector funds. And you know, the attraction of this approach is that this is a way of using official money to achieve some private sector debt relief preemptively, which would not require defaults or distressed debt exchanges. So it would not damage relations between the debtors and private creditors, which was sort of the big hurdle for bailing in the private sector in the context of the DSSI. And it may not cost the official sector anything, because it's basically just about lending. So intellectually, this is a really nice idea. The problem here, I think, is that this can only be small scale. So if you try to make this a really big instrument, you're going to undermine its effectiveness, because secondary market prices are going to rise. The debt relief impact will be very small. Moreover, you're going to undermine the preferred creditor status of the IMF, which partly makes this whole thing work. So this gets technical, but sort of my view, it's a good idea, but it can only work in a small way, and as such, it cannot be the main vehicle. And so that leaves, you know, the approach that is, you know, by default, I think, the preferred approach of the official sector, most of the official sector, which is case-by-case deep debt restructurings with comparability of treatment and as much official sector coordination as possible in the context of IMF programs. So this can potentially address both of the main problems of preemptive debt relief. It gives you debt relief in cases where it is truly needed because it's based on, it's case by case, it's based on a debt sustainability analysis, and it would involve all creditors. That is not to say, of course, that this is problem-free. And so Christina actually mentioned one very important problem in her opening remarks. It requires a DSA, a debt sustainability analysis, that actually gets it right? So the DSA cannot be too optimistic, cannot be based on optimistic growth projections. Otherwise, you're going to deliver too little debt relief. So I fully agree with it. And personally, my role in the IMF is to make sure that the DSAs get it right, that we are not too optimistic. And that is sometimes a tough battle because there are trade-offs, right? If you have a very pessimistic DSA, that means you need a lot of debt restructuring. And this is not just good for the country involved. It's also costly because the economic and reputational cost of restructurings go up with the depth of restructurings. And of course, the second and in my view, biggest potential problem with this approach is it needs to be initiated by the debtor country, right? So the country needs to come to the IMF. If you do preemptive debt relief, you're sort of just bestowing debt relief on countries. And this requires the initiative of the country. And we know that countries and economic and political elites in countries face incentives to come to the IMF and generally, or to their private creditors, too late. So this is the well-known too little, too late problem. And the interesting twist in here, and that's sort of one of our worries when we are considering of whether to and under what conditions to extend the DSSI, or rather to, we as the IMF to advocate extension by the G20, is that continued access to finance, whether it's market finance or official finance, could actually make these delays worse, right? So if there's a built-in propensity of policymakers in debtor countries to sort of want to delay dealing with deep debt problems, then, by giving them extra financing, you're postponing the day of reckoning. And so it is very important to structure initiatives like the DSSI in a way that minimizes this incentive problem. So the bottom line for me is that no approach is perfect. None of the three is perfect. And we may indeed need possibly a combination of several. And then, of course, the devil is in the details. The IMF's position is we want case by case. So the third approach. But, personally, I also think we should study the possibility of reviving buybacks as an instrument, as an additional instrument that may be able to play a role in some cases. Let me leave it at that.
Okay, thank you. We'll certainly will have to come back to the issue of a case-by-case approach versus something that could be called group-wise or global or whatever, but that will be a bit later on our agenda. I would now like to pass the floor to Patricia, because Latindad has been very much at the forefront also among NGOs in demanding that debt relief options in whichever form must not be confined to just the poorest countries. I mean, that's understandable from a Latin American perspective, of course, but that there are countries that are completely left outside at the moment, but still have a huge need for obtaining something like a comprehensive debt relief. Patricia, who should be included in debt relief efforts in the present situation with the pandemic and with the crisis that was already there before the pandemic? And what does civil society in Latin America think about how this could be organized, extended? What's the proposal that you are waging?
Thank you, Jürgen. Indeed, Latindad and with our members in different countries have been analyzing and discussing all these initiatives from the global financial community to face the pandemic and the crisis itself. The criteria of GDP per capita that is mainly used to classify countries has been criticized several times by different stakeholders and different arenas, because these criteria hides other vulnerabilities that countries have, other social vulnerabilities that are not reflected in just a ratio of GDP per capita. So in that sense, and as you well said, almost all Latin American countries were in fiscal deficit before the pandemic outbreak. And several of them have more than 2 years of fiscal deficit. In addition, there are countries with a very limited fiscal space to react, which is also exacerbated for the highest recession ever. There are already some figures and also projections about the decrease of fiscal revenues in several countries. So in this sense, there are, and the projections, it looks like for Latin America, the recovery will not be a V recovery. It will be a U recovery, but maybe a very long U, which is showing that we will have a slow recovery of these multiple crises. What we say is that the pandemic only accelerated the arrival of different problems and risks that we were foreseeing and alerting as civil society organizations in the past years. And we are going through a multiple crisis. Regarding your question, your second question, there are another concern that we have is that the main options for Latin American countries or for middle-income countries to face this crisis is by new credits, new loans, IMF loans, but also, as has been said, the issuance of sovereign bonds from different countries. So it's for the crisis that we're going through, to resolve it with more debt and with more loans, it's just to postpone the problem, is to get resources now, but postponing the fiscal problems, because with the recession that our countries have, and the IMF itself already said that this would be another lost decade for Latin America, there is no guarantee that these countries will actually be able to repay the debt that they are having now to face the crisis. So it's postponing the problem for the next years. In the case of the IMF loans for some countries in Latin America, as the Rapid Finance Instrument, the RFI, whether the interest is low, we can say it's around 1% rate, but it has to be repaid in 5 years. And it will be very difficult for some countries to actually repay that. So we know beforehand that other measures will have to be taken to address this in the next years. So these are our concerns, and in this sense, which countries should? First, we think that it's important not only to take into account the capacity of repaying the current debt, to see if a country needs another type of support, as a debt relief, as a DSSI. There are also other vulnerabilities that need to be taken into account. Not only fiscal vulnerabilities, but also social. The capacity to face COVID-19 outbreak in many countries, we didn't have enough hospitals. We didn't have, according to the World Health Organization ratios, our countries are really below those ratios to be able to face this kind of pandemic. So there are other social criteria that should be taken into account if we want to have measures and policies to react to COVID-19 impacts and other crises that come along with it. First of all, for instance, instead of offering a rapid financing instrument to these countries could be the first in line to be able to receive another sort of support, whether a DSSI or whether a debt relief. There are several countries that received this loan, as for instance El Salvador, República Dominicana, Bolivia, Paraguay, and these are, instead of having a credit that has to be repaid in the next 5 years, these countries could be the first in line to receive a different treatment. And in addition, what has been said before about the capacity of issuing sovereign bonds, this is the same risk. It's receiving fresh resources now, but with a really high risk of not being able to repay in the next year. So in the next years, our countries will face again the same question about, well, do we prioritize the debt service payment, or do we prioritize the social protection or social investment needs that we will still have, because this will be a very long recovery. I think I would also like to others and support what Christina said at the beginning about the liquidity. Yes, right now we have an urgent need of liquidity, fresh resources now, but the solutions that our countries, middle-income countries, well, but we know that there are lower middle-income countries in Latin America, this sort of solutions will affect and undermine solvency issues in the future. So this is another message that we are raising, that current policies taken to face this crisis might also undermine the sustainability and solvency in the middle and long term.
Okay, thank you so much, Patricia. I would now like to open the floor for questions from the floor as well as from the internet. There have been a few questions raised. I would like to raise the last one that you put in, Tobias. Could you scroll down? No, the other one. The other screen. The other screen, please. Yes. Yeah. Just go down. There was a question raised by Uwe Kekretz, who is the spokesperson of the Green Party bench here in the German Bundestag, to Jakob von Weizsäcker. I just read it out because it comes so quickly. You have stated that the lack of private creditor participation is bad for our taxpayers, as we are subsidizing these private returns. Will Germany propose to make the extension of the DSSI conditional on comparable treatment of private creditors, particularly in those countries that have high exposure to private creditors or are at high risk of debt distress? That's another question about what Germany is actually standing for in that G20 context.
As has been pointed out, there are considerable technical difficulties in having the private sector participate in those kind of liquidity measures. Because, not least because it leads to a downgrading of the rating and then triggers a certain number of events, as has been pointed out. That is slightly different in the case of solvency issues, and when one moves to debt restructuring, where in principle, of course, comparability of treatment can be imposed. And Jomin has expertly pointed to the fact that not automatically would a country always, especially if the relief is relatively small, want to go for it. But there can be very plausible circumstances when a country is clearly insolvent, where that's very much very much on the cards. And so by simply extending the official creditor DSSI, this day of reckoning where the private sector would become involved is of course pushed back potentially to a point where then some private creditors simply would no longer be there because they have a way to get out. And that's the difficulty we're in. And since I dodged a little bit the question what the G20 is going to do, I'm now in the happy position because the G7 ministers met today to read out what the ministers agreed on, the G7 ministers, at a statement exactly in the context of the difficulties I just outlined. The paragraph reads, recognizing the ongoing financial needs of low-income countries, we support extending the DSSI in the context of a request for IMF financing. The modalities of the extension should reflect the G20's commitment to transparency and creditor coordination, including an understanding on key features of debt treatment beyond the DSSI, which sort of very much rhymes with what Jeroen and myself have just told you, as well as the need to reflect a need for fair burden sharing among all creditors. And that is, of course, an allusion to the problem of private sector participation. And then there's, it goes on a little bit, the paragraph, because of course there's some official creditors who've decided, at least partially, to try and pretend they're private creditors, which is a sort of additional problem to do with some emerging economies. And so, in other words, the G7 does play an important role in this. I think what the statement says is that the G7 is in favor of a measured DSSI extension, but conditional in making sure that the various aspects that we've just discussed will be borne in mind. So in order to do that, clearly we cannot simply have a blanket extension, say for 12 months, but there are certain prerequisites that need to be fulfilled so that the objective laid down by the G7 ministers can be met. So just to come back to the question, because it was a slightly long winding answer, the point is, it is technically rather difficult to simply say, now let's make a private sector participation in the liquidity support mandatory, but it is entirely possible to make certain that we do not have an indefinite period of public sector liquidity support. It is entirely possible to say in a stage approach, as it becomes clearer which countries are clearly insolvent, as if you will, the debt sustainability analysis becomes more dependable because the future becomes a little bit clearer, that we then rapidly move into sort of the right track rather than procrastinate just sort of providing liquidity for solvency issues. And that would really, I think, have to be the answer I can give to, who was it who asked the question?
Uwe Kekeritz.
Yeah, Uwe Kekeritz, yes.
Mm-hmm. Yeah, thanks for this very up-to-date information, and also for trying to translate communique language into plain English. That's always very helpful. We have the opportunity also to raise questions from the floor here, if somebody wants to raise his hand, or if somebody from the panelists wants to react. Okay, then we have Tobias Pillings of the Ministry of the Economy. You need to go to this black spot over there, and you'll get a mic. You can put it down when you're there. Okay, this is Tobias Pillings, who is with the German Ministry of the Economy and who leads the German Paris Club delegation.
Yeah, thank you very much, Jürgen. So there's no need to introduce myself anymore. Tobias from the German Ministry of Economics. My question goes out to Mr. Daly, whose reply to Jürgen's question, why the private sector showed zero reaction to every sort of effort to make it participate or to ask for its participation in the DSSI, was very candid to my perspective, saying that it was not mandatory but voluntary. What would the private sector have done had there been an initiative of it being mandatory, whatever that might have been? Thank you.
I mean, what we've done, I think we certainly, we would have, formed a group of investors. I mean, I should say there's already an existing group of about 25 to 30 investors, constitutes a group called the Africa Working Group, which we put together shortly after the DSSI was announced, just so we could have a sounding board of investors to talk about, these issues as they arise. Through this group, we certainly would have reached out to these countries and try to get some understanding as to what their intentions were, because I think the reality is that one missed coupon turns into two missed coupons, turns into three missed coupons, and this is the difficulty in trying to come up with a NPV neutral agreement with creditors. It's much easier to do that with bilateral loans because they're not marked to market. But since our bonds are marked to market on a daily basis, if a country or countries had announced that they intended to not to pay these coupons, you would have had a significant loss in the underlying value of those particular bonds. So trying to understand or trying to calculate what is NPV neutral on missed Eurobond coupons would have been very, very difficult. So there's discussions there. I mean, but I think again, we would have asked them to go through the formal process, which is again they have to file a consent solicitation to delay the coupon payment. But the uncertainty, I guess, would have, whether or not this was more than just one missed coupon payment, would have triggered significant losses on the bond. So we're already taking a mark-to-market hit on these investments, and the reality is that we have institutional investors, big clients who invest in these countries. There would have been questions that we would have been asked by our clients in terms of what's the intention of this country? Do you feel going forward that it makes sense to maintain your exposure to these countries? So there's a lot of shall we say discussions that we would have with our underlying clients if this were to occur. So it's I guess it's a series of discussions that we would have with the issuers, with our clients, with a broader set of investors to figure out again what is the intention of this particular country or countries. And if you're looking at again coupon payments coming due over the next year on their Eurobonds, we're not talking about a significant amount of money. I'm not trying to downplay the amount of money that obviously is still at this stage probably extremely important for these countries. But to have the problems, the knock-on effect of losing access to private sector capital, I think that certainly could have been very damaging to some of these countries. Now, I think this is also a good opportunity just to mention on some of German's comments about whether the multilaterals would be, they would obviously have to provide more financing for these countries in the event that they were to miss one or more coupon payments on their bonds. So I guess the good news for these countries, if there is a positive here, is that there's no real significant maturities on these bonds over the next several years. Had that been the case, I think it would have been pretty straightforward that you would have seen countries reaching out to creditors like Zambia is doing right now, because it's clear that they are not really in a position to repay that Eurobond maturing in 2022. you would add more examples of that, right? So I think, you know, again, echoing what Jeremy has said, I think on a case-by-case basis, I would not be surprised if we have more Zambias over the next couple of years, countries which are faced by these rising debt problems, and debt sustainability becomes more obvious over the next several years. So the question is, you know, going back to these, you know, our involvement, what we do. I think, you know, we would do what we always do with countries when they want to engage in a delayed coupon payment. We would ask them, or we would certainly expect them to go through the process, as I mentioned earlier, that we saw with Ecuador back in March and April, where the government was very proactive. They reached out to investors. They indicated their plans. They sought a 4-month consent period to stop interest payments on their bonds, and it was a pretty, you know, smooth process. You know, in contrast, you saw how long it took for Argentina to restructure. I think, you know, Zambia would be a very difficult one too, because of the amount and difficulty they might have with these various Chinese loans. So, but no, again, we would expect and want to have a dialogue with these countries, and I think, you know, I think there would be, if you asked various members of this Africa Working Group, I think we would all realize that over in the coming years, we probably will see, you know, there certainly is going to be an increased risk of further debt restructurings.
Thank you. I think nobody would be surprised to see more Zambias coming up. The problem seems to be that the Zambias and the Ecuadors that you mentioned, they are always negotiating in a very distinct way with all the different creditor groups, which is not always a recipe for effectiveness. Christina had asked the floor on this.
Yeah, not only on this. The first thing, or the first point I would relate to is what Jerome said about preemptive debt relief. So your concern was that too steep preemptive debt relief could be a problem for developing countries. And I think if we just look into the past, I think in the past that was never the problem, that there was too much preemptive debt relief. I think rather the opposite. So when I have a look into the data, I think for the last 25 years, what we saw is that 35% of all commercial restructurings were followed by another commercial or Paris Club restructuring within 1 year, 60% within 2 years, 70% within 3 years. In Africa, Paris Club agreements, right? There is no country, not even one, that did not have to negotiate with the Paris Club several times. I think on average it was 7 times that countries had to negotiate. So I think the problem was that we actually did not have too steep preemptive debt relief. So what we have or had was a too little, too late problem. I think that's the words of the IMF. And this was really costly to everyone. So I'm just wondering, given the current circumstances, given the current crisis, which is also in the words of the IMF, a crisis like no other, shouldn't we be a bit more brave? Wouldn't it be in the collective interest to be braver and just try something new and perhaps be a bit more preemptive, a bit more steep? That's one thing. The other thing is on creditor coordination and fair burden sharing. So Mr. Weizsäcker, you said that it's actually entirely possible to involve private creditors when it comes to debt restructurings, but not now when it came to debt suspension. I'm just wondering what would be different from March, when actually things really looked worse and when private creditors were not at all willing to be part of a suspension, which is really just suspension, which is not about losses. Why would they actually be willing to more participate when they actually perhaps have to face haircuts and losses? That I would be really interested to hear why that would be better. And I think what we can actually learn from the debt standstill experience, from the experience with the DSSI, is that to achieve effective participation of commercial creditors, this will require much more than just simply appeal and hoping for the best. So given that there is no creditor coordination mechanism, actually, if I were a private creditor, I would actually feel like an idiot to participate in something, be good-willing, perhaps accept losses or spending, when actually concurring creditors would then kind of free ride on my concessions, benefit from my concessions and being paid. So I'm just wondering, on my view, this means the only way to make PSI possible and to really ensure fair burden sharing, because I think this is all about creditor coordination, fair burden sharing, I think is that the public sector in its legislative function should organize this process. I think it is the responsibility of the public sector to kind of act, to establish rules, procedures, when there is a norm conflict between, on the one hand, a very legitimate payment claim, and then on the other hand, the payment capacity of countries that is perhaps not there anymore. So I'm just wondering if suspensions, if debt restructurings are not being organized by the public sector, I do think that the alternative will be disorderly defaults. I think it will be very costly debt crisis. And well, I think you actually right now pay the price that we haven't used crisis in the past, the opportunities we had in the past to organize creditor coordination. And I'm just wondering, what better time is there to actually also find this kind of systemic solutions to creditor coordination?
That last point sounds a little bit like an exculpation of the private sector and a very strong question to those who represent the official sector here, which would be Jeremy and Jakob von Weizsäcker. As Jeremy has to drop out in about 15 minutes, I would very much ask you to perhaps first react to the point that Christina had raised. I would like to add one question that came from Bodo Elmers about the DSSAs. I just read it out because I think it's well formulated. The IMF is putting a lot of effort in doing debt sustainability analysis. When DSSI was agreed, DSA ratings played no role at all for eligibility. The only criterion was if a country is categorized as LDC or low-income countries or not. What is the point of doing DSAs when they don't guide policy decisions? Shouldn't the IMF insist that DSA ratings determine eligibility? These are two questions, but we very much look forward to your response. And then,
so the second question is easy to answer. So the DSSI was a liquidity provision, a financing provision initiative by the G20, and the presumption was, and our analysis showed, that all the countries benefiting from the DSSI had financing needs. On top of that, the DSSI, in most cases, not in all cases, went along with emergency financing from the IMF. When it comes to IMF money, even if the money is only about financing liquidity, which is the normal case, together with economic reform, there is a DSA, right? So whenever our own emergency funding facilities were used to complement the DSSI, a DSA test had to be passed. So that's true both for our emergency financing facilities and for our standard facilities. And then on Christina Rehmann's point, so I completely agree with you that we have to be braver, and in particular, I completely agree with you that the big challenge is not to let this problem fester, right? I mean, we are completely on the same page on this one. There's a real danger that if debt problems accumulate, we're going to have disorderly defaults. And so we need sooner rather than later a resolution of debt problems. But at the same time, we cannot ignore the fact that there are global resource constraints, right? So if you do debt relief, someone else will pay. Now, we can argue that the official advanced countries, the creditor countries, should be more generous, but I think the principle that there are limits to generosity because money has opportunity costs, I think is one that cannot be seriously put in doubt. And so assuming there is a resource constraint, and you can make it as large as you want, just set some limit. If we were to give the same debt relief to two different countries, one of which does not need it, quote unquote, in the sense that it has at best a liquidity problem, and the other one has a very deep solvency problem, then clearly this is not the best use of public money, because the problem of recidivism that you mentioned correctly is going to be made much worse in the country that does not get enough debt relief. So if I need 10% NPV haircut to make one country sustainable and 60% NPV haircut to make another country sustainable, it's better to give them what they need rather than to give everyone 25%. Now, you could argue maybe one can combine a preemptive initiative with, tailoring the amount of debt relief needed to the country circumstances. Once you do that, though, you are in the realm of the case-by-case approach, which is basically where I want to get to, and where the IMF and the official sector by and large are. And then the question is, how exactly do you structure a case-by-case approach? And here we have a template, which is that countries that think that they require external help apply to the IMF for external help, and then together with these countries we decide what the nature of the help is that they need, whether they need deep debt relief or not, and then we go from there. So that's the standard template. As I have freely admitted at the beginning, it's not perfect, right? But I think it's better than the alternative of just giving across the board debt relief of the same amount to everyone.
Okay, thank you. Frankly, I never heard about a resource constraint regarding debt relief. That was something particularly new to me.
Oh, really? Then Jakob should tell you about that. Seriously, if you have never heard about that resource constraint, you need to hear from a Minister of Finance or his representative. Yeah, there is a resource constraint. There are taxpayers that are paying for this.
I understood you to mean that there was a resource constraint on the creditor side.
That's absolutely what I mean. These are public funds in creditor countries, right? These are public funds in creditor countries. This is not a free gift. Now, you may argue that there is a big argument for redistribution internationally, and I may agree with you to that point. But to say that there's no cost to debt relief, I think that's absurd, frankly. Jakob, you should come in on that.
No, there's definitely a cost. I would not say that there can be a constraint in terms of amounts, because that's money that you have lent already. But Jakob from Weizsäcker, would you want to get into
perhaps let me say two things. First of all, obviously there's always a constraint, and that's the political willingness of the Bundestag, of a government, to allocate their resources in a certain manner. And that is an important constraint that needs to be borne in mind. If you take bilateral credits, if you forego them, then of course there is a fiscal cost. If you do it multilaterally, just look at the cost of the IDA rounds. Just look at the cost of funds that are dedicated to providing debt relief at the IMF, which of course the IMF doesn't normally do. There comes a fiscal cost. There's no doubt about it, and the Bundestag votes on it. But I want to come back to this question of the debt sustainability analysis. Of course, they're being done. And Jeroen makes sure that they're of good quality. But depending on the overall environment, they can be more certain or less certain. And I think it's fair to say that in March, in April this year, the uncertainty was enormous. And even, the best experts on a country doing a debt sustainability analysis would have been hard-pressed to justify certain assumptions about the economic situation 10 years down the road. It would have been very difficult, very courageous, many of these assumptions. As we move along, and that, by the way, that's the reason why DSSI not conditioning so much on highly uncertain, I wouldn't say dodgy, but highly uncertain sustainability analysis would have been a problem. That's why we didn't do it. But as uncertainty is reduced, I'm coming back to my point in the introduction, and I think uncertainty will be considerably less. It will still be high, but considerably lower in 2021. We can increasingly use our take in a debt sustainability analysis, which would have become more reliable in order to decide, well, is this a solvency problem or is this just a liquidity problem? And the sooner we're able to do that, the better, since we didn't manage to get the private sector properly involved in the liquidity instrument. And we've mentioned some of the points. It is actually, it is doable. But the difficulty is things that are classified as default events, they come at a cost in terms of losing market access. If you get a lot in return by way of debt relief, that's probably definitely worth it.
Mm-hmm.
If you just get a little bit of liquidity relief, it's not clear, and Jerome has made this very explicit, that debtor countries, if it's made compulsory, would have actually gone for the official liquidity assistance, because it would have been a package deal, and they would have said, yes, it's nice to get a bit of official liquidity assistance, but there's a drawback in terms of the impact on our private sector market access, and perhaps the total package wouldn't have been attractive. So it would have been doable, but it probably would have led to having rather fewer countries rely on the DSSI. And so I think that's why this question, how reliable is the DSA, is key. It is key to explaining why we did a yes, imperfect DSSI in 2020, and why we need to move to a more differentiated approach in 2021 rather than procrastinating.
Okay, thank you. Before I move on again to the question of comprehensiveness of debt relief, I have to apologize to Patricia, who intermediately dropped off my screen here, but obviously raised her hand. So Patricia, the floor is yours.
Thanks, Jürgen. Well, I would like to bring some reactions from my side, and also some questions as well to the panel. Regarding the negotiation of Ecuador with private creditors, I would like to make a comment on that. We have civil society organization members in Ecuador, and there have been complaints and concerns about these results. And part of those is why it was a smoothie process if we compare it with Argentina. And part of that concern is because the interests that have been capitalized with coupons and bonds to be repaid in the future have the risk of anatocism, so to have interest paid over interest in case Ecuador is not able to repay those new bonds, those new coupons. So what is if I would like to ask if this is part of the negotiations, what is the analysis on these risks? And Ecuador had already a similar situation some years ago with private debt, so they feel, and civil society organizations in Ecuador feel that they are going through the same path again. That is one issue. And also would like to continue another reaction on the private sector, or it's a comment. It isn't what we would like to say as well is that there is a co-responsibility between lenders and borrowers. And given that this is the highest recession ever, a crisis with no precedents, wouldn't it be an argument to consider to bear a part of this cost and to share these costs between creditors and debtors? Because where do private investors allocate their investments? It's a big and an important part of that allocation is in countries, in the public sector of countries. So if governments and countries fall and cannot repay those debts, and given that the recovery will be really complex, then private investment will also fall. So it would be it can be a lose-lose situation. Do you have any analysis on this? And another concern is how this Several panelists have been mentioning that the countries have to go and knock on the door. They need a debt relief and to do it timely and not late. But this fear to be punished, to have a downgrading rating after doing that, after knocking that door, it is a real situation for many countries. So one of our concerns is what is the role of credit rating agencies in this crisis? And there is a proposal from the United Nations Economic Commission for Latin America to propose an independent credit rating institution. So I would like to put that on the table if you have any reactions on that. And there have been many comments about the DSA, and the DSA has been used whether in debt relief initiatives, in the HIPIC initiative, the MDRI initiative. It has go along with programs as the PRSP when we had the HIPIC implementation. But it's a tool that it is used by countries. It has a methodology to have macro fiscal projections. Maybe it's a bit weak still in having social investment projections, but it is a methodology that it is used by countries. But the criteria to assess those DSAs and the assumptions and projections, that is an approach that we think it's weaknesses, especially now in this crisis. That limits policy has to be, as well as the DSA, has to be updated, has to be more integral and comprehensive to include all types of risks, to include more different criteria of assessment, including even new ratios that can be corresponding with the current debt landscape, which is not the same as we had back in the last debt crisis, or back in those debt relief processes that many countries have. It is different. So I think that is the one key aspect that it needs to be taken into account. And I wanted to briefly mention an experience that some countries in Africa and in Latin America had after the HIPIC implementation. There was a program financed mainly by European countries that was a program to help and support countries to develop a financing strategy, so they could go in the path of to achieve sustainability, but not only under the approach of having a sustainability that criteria, which is the capacity of repayment debt. It also included at that time the accomplishment of the MDGs and to go together with national development plans. So in that experiences, countries used the methodology of the DSA. They used also different criteria and ratios led by countries themselves. And in those experiences, the over-optimistic assumptions were handled by, in some cases, not all countries, but there are experiences where other stakeholders have been brought. It was a thing of having 2 or 3 weeks of having different ministries, not only finance ministries, but other ministries as development, the central bank, and also other stakeholders that included private sector to validate those projections made by the government. And I think those kind of initiatives empowering as well the decisions and the policies at national levels, involving other stakeholders as civil society organizations and also the private sector, are important to have the better and the most effective criteria to define how to define the restructuring implementation, the debt restructuring or debt renegotiation implementation for each country. So I wanted to share that, and I'll stop there. Thank you.
Thank you, Patricia. I think the majority of what you said had been challenges to Jeromy Zettelmeier, whom we unfortunately have just lost to Kristalina Georgieva. If anybody wants to respond, I saw a hand from Kevin Daly, and we have one hand up here in the room. So Kevin first, and then.
Sure. Yeah, I'll try to address some of the points that Patricia just made. Before I do that, I just wanted to respond to something that Christina said previously, which was that private sector hasn't done anything, right? That we haven't been active. I think, on the contrary, we've been very actively involved behind the scenes with the IAF, working on various responses to the official sector. We've been involved in discussions with the Paris Club. We've had discussions with Jeremy and his team at the IMF, with the World Bank, with the European Commission, and other various entities. And a lot of these discussions have to do with coming up with a public-private sector partnership to help provide cheaper financing for the IDA countries. And this would entail partial guarantees, which could be used to help kickstart the issuance of SDG bonds. And I think this is extremely important, will be extremely important for emerging markets and IDA country in particular going forward. And the reason being is I think we have, of the, 16 billion in EM debt we manage, we have about over 2 billion of that is in ESG funds. And that part of the market is only going to be growing in the coming years. A key part of that is our stakeholders, our clients want countries to be more transparent. They want to understand where the use of proceeds are going. And for clients that have these type of mandates right now, unfortunately, there are some exclusion lists, countries that we can invest in. But if these countries start to issue SDG bonds, that will open up the opportunity set that will expand the investor base for these countries. So I think this is something where we've been working extremely hard behind the scenes, trying to push this public and private sector partnership to help expand the investor base, in not just emerging markets, but in particular for these IDA countries. And I think again, we're continuing to have these discussions. So, we had a couple of years ago the IFC and Amundi. They launched this green bond initiative, which is over 2 billion. I've had discussions, and various investors have had discussions with the IFC over this green bond fund, and the IFC is willing to do something more here, right? So there is appetite out there, and I think, and again, the IF is doing a survey of its members now over the next week or so to discuss, what is our potential response going to be to DSSI 2.0, which we're all expecting, and obviously it sounds like it's going to happen now. So there are a lot of things we are doing behind the scenes, and again, I think the key thing here, and the message that was imparted to me by the UNECA and by the African ministers, is they want cheaper financing, right? And this is this is probably the only way in this current environment that they can achieve that, is through some partial guarantees. But I think more importantly, it will make countries more accountable if the use of proceeds are more transparent. And I think that's this SDG market is something which we believe is extremely important for the future architecture of our EM bond universe. Now, the good news here is we've had discussions with JP Morgan about index inclusion. That will again make it important for investors who are investing in these type of bonds. They've just recently announced that they're including the Ghana 2030 bond, which is the partially World Bank guarantee bond. So these are, you know, discussions which we have been reaching out to ensure that the index inclusion will be an important aspect for these partial guarantee issues going forward. So that's something that we're continuing to push very hard behind the scenes, and we hope, you know, this opportunity happens, that this opportunity we're at now, that this market can start to develop, because I hear the criticism about private sector loud and clear. The criticism that we're being bailed out, but no, on the contrary, we'll be being bailed in. We're bringing more capital and cheaper form of financing to these countries. So I think in return, obviously, we'll want to ensure that there's accountability there in terms of the use of proceeds. Now, to Patricia's, some of the points Patricia made first of all, on Ecuador complaints and concerns. I think, yeah, I mean, obviously the finance minister Martinez, he's being impeached now because of his handling of this situation. I think they, as far as investors are concerned, they did things by the book in terms of, they sought a 4-month consent solicitation, coupon payments were halted. At that point, we had Ecuador bonds, I think, hit 30 cents on the dollar. We were actually forced by some clients to have to sell those bonds. So, we took a big financial loss. The clients of ours took a big financial loss. Today, the value of those bonds have doubled, more or less doubled. So for clients who were not forced to sell because of the rating triggers, they've benefited by, being a long-term investor. But unfortunately, some investors have mandates which forbid us holding bonds which are rated below the B- level. So there has been, burden share in there, right? There are clients of ours who unfortunately have taken big losses, and we don't know what the underlying implications are potentially for us going forward. And they might look at us as an investor and say that was a poor investment decision, and therefore, our potential relationship is at risk with clients like that from time to time too. So this is the downside for us being running institutional investor money. Sometimes they will question us if there's a wave of defaults with countries. And again, we all understand and believe in the long-term, being long-term investors and bringing capital to these countries. We're not, we're not a hedge fund moving in and out. We're a big, EM manager, 16 billion, and we do invest and have been long-term investors in a number of these IDA countries, which is my area of expertise on the team. Now, again, co-responsibility between lenders and borrowers. I think there is a responsibility there, certainly, that we take very seriously. We engage with these countries when we meet them on roadshows or non-deal roadshows. We want to understand what is the fiscal sustain, what is the fiscal plans that this government has in terms of their where the resources are being used or spent. But unfortunately, there's not a whole lot of transparency at that after the money is lent to these countries. Going back to an SCG type of bond issuance, I think you will get more transparency, more accountability, because that money will have to be. Yes.
Excuse me, we still have 2 more people who want to speak up.
Okay. I'll just say one more thing here. The last thing is on the rating agency thing, and I used to work for Standard & Poor's for a number of years, so I know the rating agencies dialogue and debate very well. These agencies are independent, right? They have their own credit opinions. Now, our clients have mandates which will put in ratings by at least 2 of the rating agencies, or 3 in the case if there are 3 ratings. So these are mandates that the clients have, and that they will be based on ratings of the 3 major rating agencies. So that's something which is out of our control. Yeah, I'll stop there. So yeah, apologies for going on there.
Yeah, thank you. Sorry for cutting you off.
No,
it's just
that's fine.
we have one vote here from the room. Please go to the interview spot and identify yourself. And then I would like to read out a question that was raised online by Aldo Cagliari, and then invite the remaining panelists to come up with brief, short, concise responses so that we stay in the time frame.
Yeah, hello. My name is Johannes. I'm from Heinrich Böll Foundation, a green political foundation in Germany. When we think back to HIPC, there was a debt relief, but there was also a concomitant commitment by the debtor countries to essentially poverty alleviation measures in a variety of ways. So I just wonder whether in the new situation where we are in, where the climate crisis is high on the agenda, where we are in the run-up to the next COP in Glasgow, where there should be some kind of deal between debtors and creditors that essentially debt relief should be coupled with enhanced action on climate change, which is in the public common interest of everybody, and where we can also see that actually climate action, especially on adaptation, also enhances debt sustainability. And we see, I mean, there's this call for green recovery everywhere. There has been recently an op-ed by the former central bank governor of Pakistan, Shamshad Akhtar, Kevin Gallagher, and a number of other people, including myself, who was actually proposing this. And I think I would just want to get some reaction. Is it helpful, useful, pertinent to get some kind of global deal enhancing action on climate change and coupling it with enhanced debt relief?
Okay, that looks like a great new terrain to cover. I would like to add one question that was raised by Aldo Cagliari of Jubilee USA, adding one remark from my own side. Aldo writes, creditors participated more than 90% more than 90% of private creditors participated in the HIPC initiative, which was one size fits all. And it was voluntary, so to speak. No credit harm has been reported for the recipients. If anything, the opposite. After HIPC, countries gained further access to markets. And we, at least in hindsight, found that the idea to define a ceiling for sustainable debt and then cut off whatever is beyond the ceiling was a fairly good approach. This is what irritates us a little bit when everybody speaks about one size fits all cannot work, because that was an instrument actually developed by the G7 and the IMF, and it, in our view, it worked quite well. So what's different today? Why couldn't this work? So these are 2 points about the linking debt relief and climate financing, and a comprehensive approach like HIPC. Could it work? Why could it not work? And I ask all the 4 remaining participants to comment briefly, because we've got not more than 15 minutes. Who wants to start?
I'm happy to start and I'll be very brief. Just on HIPC, because I did see that question earlier. And what I would highlight, first of all, is we know when HIPC was completed, pretty much there were no countries at that stage that had issued publicly traded bonds. So the debt relief initiative itself was probably going to be, well, if you had a HIPC 2, it would be much, much more complex given the level of not just bond issuance, but loans that these countries have taken on over the last decade or so. So I think that will make it more difficult. I agree that these countries would, if you did, obviously sharply reduce their debt levels. I mean, there would be a period of time where they would be shut out from financial markets. But I think, those with sustainable debt levels and growth and relatively market-friendly politics or just in terms of the growth prospects of the country, I think these countries would be able to come back to the financial markets, but there would be an uncertain period where they would lose access to capital, private capital. And the question is, who is going to fill that gap? The one thing I would add, though, if you look at HIPC countries, there is one very successful story out there right now, and that is Ivory Coast. If you look at Cote d'Ivoire, This is a country which got significant debt relief. And it's probably one of the few countries in the region in sub-Saharan Africa that hasn't seen its debt levels increase significantly to the point where, people look back and say, well, this is a story which has really deteriorated. And obviously it's the highest growth in the region over the past decade, and generally been very in terms of how they manage their fiscal affairs. It's generally been a country which has been very prudent in terms of how it how it issues its debt as well. So there are success stories out there. I mean, but clearly, if you look at all the countries that are involved in HIPC, yeah, you could certainly say their debt levels have increased markedly in recent years.
Okay, thank you. Regarding the speed of regaining market access, this week Belize got its restructuring, and it took it 24 hours after finalizing the agreement with the private sector, and they were out of sovereign default ratings. So that can work very quickly, provided the relief is provided. Okay, who else wants to comment on either of the 2 points? The climate financing point or the HIPC 3, or however we want to call it.
I'm happy to come in on both points. On the climate financing, as economists, we quite like to refer back to the so-called Tinbergen principle, that when one has 2 problems, ideally one would want to resolve those problems 2 instruments. And there clearly is a global problem with climate change, and we need instruments for that. One of the instruments, as you know, under COP is a commitment by the developed countries to provide $100 billion in support to developing countries in order to help them fulfill their climate targets. I think at this stage we're struggling a little bit as the developed world to provide these 100 billion, and that's a problem, and probably more might be needed. But the point is, we have an instrument there, and I think it's reasonable, and we need to work on it. I think it would be problematic, both in substance and politically, if we were to come to a point that the signal, especially to poorer countries, would be, well, if you keep your state finances in order, then reducing your CO2 emissions is not so much of an issue. But if you have a debt crisis, then you have to be exemplary in saving the climate. I think that would be an unfortunate message, and I don't think we should be sending it. So I think we need to take the debt problems very seriously. We need to take the climate problems very seriously. Where there are synergies, we should explore them. But I think going down the route of, for example, trying to fulfill our commitment under COP and the Paris Agreement by means of certain types of tied debt relief, I'm not sure whether that would be a wise thing to do. And then I think on HIPC, I mean, one of the things about HIPC is, as you know, certain countries still haven't reached the decision point. And for the reasons that we've discussed this afternoon, especially because we've encountered some practical difficulties, which I greatly regret, to really get the private sector to participate in the liquidity relief, we need to relatively quickly move to a point where we talk about solvency issues. Otherwise, the private sector money may not be there for them to, participate in any losses on an equitable basis. And that's why I think whatever the exact mechanisms will be, it needs to be relatively quick. We need to come to addressing these solvency issues relatively quickly. That's why I think we probably need some sort of a blueprint to guide us, even if it's case by case, so that there's some mechanism by which a relatively large number of countries becomes manageable. But I think having a mechanism that would work in the time frame of HIPC, I doubt whether that would be appropriate.
Because it would be too slow, you mean?
Quite.
Yeah, okay. Christina, Patricia first, and then Christina.
Thanks, Jürgen. Well, I think it's important to raise lessons learned from what was the HIPIC initiative implementation. Among one of them, because there are many lessons learned, is that it definitely it was a help, a support that let us allowed countries to download the water and let us breathe. But of course, then the water is still there. It's something. It's a lesson that we need to take into account now in this context, because other measures are also needed. I heard for many years, but what is the cost of debt relief, and that someone is paying for that, and that there is so. I think it's a little problematic for us to think of it as a generosity issue, because if our countries, part of the reasons why our countries need to get new credits and to look for new loans, it's because we don't have enough resources. And part of those reasons is because we that don't have the capacity to collect fairly all the revenues. So there are other global initiatives that are needed also to be put in place as a systemic solution. For instance, seriously tackling illicit financial flows, which is a big loss in terms of GDP for developing countries. So I think this is an important thing to say, because it's not just one approach, and to think that it's the solution. We need to address it systemically. And in that sense, also, I want to address the debt relief on climate change. And under this context and under the urgent needs, I think it's still important to demand developed countries to accomplish their commitments on climate change financing. I think that there are big gaps that still need to be fulfilled, and the liquidity that countries can have right now with a debt relief initiative in this year and the next 3 or 4 years, the liquidity and fresh resources or freed resources for countries probably might be prioritized to tackle social protection needs. Many jobs have been lost due to this crisis. We need food security, because the increase of COVID-19 contagions was to, and especially in countries with a huge informal sector, was to go out to the streets to work or sell something to get food to get food for their families. So those kind of priorities and which also relates with strengthening the productive sector capacity in our countries are also key in this moment if we talk about where to address or where to use the debt relief freed resources.
Okay, thank you. And Christina?
On the HIPIC question, I think HIPIC came because the international community had no mechanisms to resolve the crisis efficiently at the beginning of those crises, to really organize fair burden sharing right at the beginning. As said in my introduction, I think HIPIC came after a decade-long protracted debt crisis. So I think that, I mean, it's really important, of course, that we right now need to speak about what to do about solvency crises that are coming up. But we are not only speaking about solvency crisis because of the COVID-19 pandemic. I think before COVID-19 was declared as a pandemic, before anyone actually spoke about COVID-19, we already were at the beginning of a debt crisis. And I think that has been acknowledged by many actors, such as the IMF, such as the World Bank. I think the World Bank said that we are at the end of the fourth wave of debt. I think other actors said something like there are regular debt cycles and now we are at the end of one of those debt cycles. And I also think at the beginning of the pandemic, there was an acknowledgement that this time, this crisis is much more systemic. It is global. It is not concentrated on specific regions. It's really a big problem. So that was there before the pandemic. This is why I think while it is really important to talk about quick and short-term measures to resolve solvency crisis coming up due to COVID, I think we really should be preparing for next time. And at the same time, besides short-term measures, we should also talk about long-term measures so that next time you don't have to regret that actually it's really so difficult to get creditor participation, so that you don't have to regret that we actually don't really know what to do and what's going to happen. So just an appeal and an encouragement that at the same time, when you speak about extending DSSI, etc., that at the same time you also think about initiating a process to discuss something more systemic, to discuss systemic reform and multilateral responses that are there, and there is a next pandemic or a next global debt crisis, or let's say we are at the end of the fifth wave of debt debt crisis.
Okay, thank you so much, Christina. I don't know if I saw more hands coming up. I think I have to apologize at this moment to all whose questions we could not take on board. We are sorry about this, but we didn't have a longer time frame than this, and now we are very close to 18 hours here in Berlin, so we have to close. I would like to thank all of you, particularly to Patricia and the battery seller in your neighborhood who helped us to stay on and made it possible that you could be with us today. Thanks to Kevin, to Jakob von Weizsäcker, to Christina, to the technical staff who helped us to get this organized. This was something completely new for us, this hybrid format here, and we are very grateful that this worked. This debate doesn't, of course, not stop today. You will know that the World Bank IMF annual meetings are coming up, and there is a civil society policy forum going on with the first event co-organized by Alasia, but also under the leadership of Eurodat, and I think Latina is also involved in this. As early as next Monday, 8 a.m. Washington time, so stay tuned. We all very much look forward to October 14th Finance Ministers meeting. I think we will really expect to get a bit more interpretation of what the G7 and others will have decided by then. And if you allow a movement veteran a final word on this, what we live through now, to me, it feels a little bit like the run-up to the Cologne summit in 1999. Yeah, we knew something was coming. We knew that the situation was absolutely untenable, but we, as always, mistrustful NGOs suspected that there was something completely insignificant was coming up again, like a few percentage points here or there in the Paris Club. And then we got a positive surprise because it was a comprehensive mechanism that came, which was not working like this before, had to be reformed a few times after this. And if we can say anything about this very, very unsecure situation that we have now, is that we need positive surprises. And some of you can contribute a bit more to those positive surprises than others. We ask you to do that.